Welcome to Iron Financial, the explainer, where we drop the heavy anvil on market noise and help you forge a significantly stronger portfolio. I'm your lead analyst, and today we are methodically stress testing the structural integrity of Monster Beverage Corporation's absolutely historic Q2 2026 earnings report. To put this in its proper historical context, crossing the $2.5 billion threshold in a single quarter, that isn't just an earnings beat. It is a monumental feat of industrial-scale consumer demand. We're talking about unmatched top-line power, serious metallurgical shifts in their global supply chain, and underlying financial metrics that demand a rigorous inspection from every conceivable angle. And hey, before we dive into the numbers, remember to hit subscribe for our no-nonsense earnings breakdowns.
And I'm the market skeptic. You can pour all the zero-sugar energy drinks you want to celebrate that top-line number, but I am absolutely here to fire up the blowtorch today. Management is serving up a massive amount of hype right now, and it is our job to cut through it. I want to know what is actually happening underneath the hood. Specifically, I'm looking at the thermal stress of rising operating costs, aggressive margin dilution, and a few key declining segments that management seems desperately trying to gloss over. If you look closely, operating margins are under real pressure, and their core domestic volume might just be peaking as we speak. Let's see if this bullish thesis actually holds true weight, or if it simply melts under the intense pressure of global inflation.
Well, let's start with the raw heat of this top-line momentum, because it is impossible to ignore. For the first time in company history, Monster literally smashed through the $2.5 billion quarterly sales barrier. Net sales came in at a staggering $2.54 billion for the second quarter of 2026. That is a massive 20.2% year-over-year increase on a GAAP basis. To put that into perspective for everyone listening, they absolutely obliterated analyst consensus estimates. The street was looking for $2.43 billion, and Monster beat that by a massive $110 million. In this current macroeconomic environment, where we keep hearing that consumer discretionary spending is tightening up, generating this kind of immense pricing power and volume expansion proves this top line is absolutely ironclad. We are looking at a commercial powerhouse operating at maximum capacity. Okay, it is a big, shiny number, I will give you that. Beating the street by $110 million is undeniably impressive on paper. But listen, a top-line beat doesn't automatically mean the structural integrity of the business is sound. We need to drill much deeper into how they actually manufactured that $2.54 billion. Revenue is vanity, profit is sanity. If you were spending $1.20 to make $1, that top line doesn't mean a thing. Which brings us directly to the central debate of today's explainer. Is Monster's massive international surge an unstoppable engine? Or are rising aluminum tariffs, massive SG&A cost surges, and a collapsing alcohol segment creating invisible cracks in their armor? Specifically, we need to scrutinize these rising freight in costs, the highly unfavorable geographic mix that is actively dragging down profitability, and the questionable return on investment for their wildly aggressive marketing spends. Revenue growth is great, but if it costs you an absolute fortune in overhead to generate it, your valuation is going to get heavily tested by the market. We demand proof before trusting this thesis blindly.
And we have the proof right here in the SEC filings and earnings call transcripts. We aren't just going to read the PR headlines today. We are going into granular detail on every financial figure, every single basis point shift, and every major supply chain strategy.
Here is the inspection sheet for today's explainer. We will methodically break this down into 5 key areas. Number 1, the top-line powerhouse. 2, the international alloy. 3, we'll hand the blowtorch back to the skeptic to examine cracks in the foundation. 4, we'll look at capital and catalysts. And finally, number 5, we will deliver our final verdict. Let's dive into Section 1, top-line powerhouse. So, the 20.2% top-line growth to $2.54 billion is incredible. But as any seasoned trader knows, you have to strip away the macroeconomic noise to see the true physical durability of the sales. Q2 reported sales benefited from a $48.5 million favorable foreign exchange impact.
Exactly. Hit the nail on the head. You have to strip away the FX benefit. Favorable exchange rates are a macroeconomic tailwind, not a fundamental business strategy. You absolutely cannot base a long-term investment thesis on fluctuating, unpredictable currency markets.
Fair enough, but let's actually look at the math here. Even when you strip away that $48.5 million FX benefit, the underlying FX-neutral net sales still grew by an incredibly robust 17.9%. Do you realize how massive a 17.9% core growth rate is for a mature large-cap beverage company? It shows extreme resilience. It proves that despite a persistently strong US dollar and global inflation, real consumer demand for their energy drinks remains highly durable. This isn't some currency illusion. It is sheer, undeniable volume and pricing strength. Now let's look at the segment breakdown to see what's really driving this. The heavy lifting is being done almost entirely by the core Monster Energy Drink segment, which includes the flagship Monster brand, Reign Total Body Fuel, and Bang Energy. This segment essentially forged ahead to $2.36 billion, up 21.6% year over year. The strategic brand segment, which encompasses your Predator and Fury affordable energy brands, also grew a very solid 10.6% to $143.7 million. The core engine is absolutely roaring.
But you have to look at the dark clouds gathering at the bottom of the dataset. You absolutely cannot ignore the structural weakness in the alcohol brand segment. It completely plummeted, dropping 15.2% down to $32.2 million.
Notice the massive $32.1 million drain happening right there. This segment is comprised of various craft beers, flavored malt beverages, and hard seltzers, and it is aggressively leaking revenue momentum. Management really needs to answer a tough question here. Was the entire push into the alcohol space a fundamental, structural blunder? It is the only reported category moving aggressively in the wrong direction, and it makes you seriously wonder if they are losing focus on what they actually do best. Why distract yourself with failing craft beer when energy is your bread and butter?
I get that, but I view it as a minor distraction at worst. We're talking about a segment that represents slightly over 1% of total revenue. Look at the broader picture. Net sales excluding the alcohol brand segment actually increased 20.8%. The core energy drink category growth remains extremely healthy globally, and it's heavily fueled by their zero-sugar offerings and the massive expansion of the Ultra line, which was up 19% domestically. When your core product is innovating and scaling that successfully, a slight dip in a 1% side venture is essentially a rounding error in an otherwise pristine top-line beat.
Moving right along to Section 2, the International Alloy. Let's talk about that base metal for a second. Domestic US and Canada growth sat at 11.5%. Now that is decent, but I really have to ask, is domestic energy drink consumption finally hitting a structural ceiling? US sales specifically were only up 7.1%. We have incredibly aggressive competition right now, from the likes of Celsius and Red Bull fighting tooth and nail for limited convenience store shelf space. When your baseline US market slows down to single or low double digits, it forces you to rely entirely on riskier, complex international markets to prop up this massive valuation.
Hold on. You literally can't look at 11.5% domestic growth and call it a ceiling when the US market share for the Monster brand family actually increased by 70 basis points this quarter. Gaining 70 basis points of market share against heavy hitters like Red Bull and Celsius is a massive testament to their domestic pricing power and brand loyalty. Juice Monster alone was up 26%. They are still winning at home, no question. But yes, the international numbers are the undeniable growth engine right now. International revenue spiked an explosive 34.6% to $1.16 billion.
Let me aggressively read out these granular regional spikes because they prove this international momentum is an unstoppable force. On a foreign currency adjusted basis, Latin America was up 40.4%, but reported sales were up 56.1%. Brazil is surging a massive 82% and Mexico is up 29.5%. Over in Asia Pacific, we're up 35.7%, driven by India absolutely skyrocketing 84%, China rising 62.5%, and Japan advancing 14.5%, largely on the back of Monster Energy Green's successful rollout in Coca-Cola vending machines. EMEA is up 27.2%. International is now 46% of total revenue, up from 41% just a single year ago. Market Skeptic. Look, the collaboration with Coca-Cola bottlers is clearly paying off overseas. I'll give them credit there. But expanding aggressively into these emerging markets requires deep cooler investments. Think about what it actually costs to install thousands of refrigeration units across India and Brazil just to support that 84% growth rate. It is highly capital intensive. Expanding into emerging markets introduces severe margin complexities, which actually brings me to my favorite part of this entire inspection. Let's get into Section 3, cracks in the foundation. Well, before you fire up that blowtorch, let's address CEO Hilton Schlossberg's stated philosophy from the earnings call. He said, and I quote, "We bank dollars, not percentages." And the absolute dollars generated here are simply fantastic. Gross profit was $1.41 billion. Operating income increased 17.2% to $740.4 million. At the end of the day, nominal profit expansion is what actually drives long-term shareholder value and allows for massive stock buybacks and dividends.
Oh, come on, that is a classic management deflection playbook. We bank dollars, not percentages, is exactly what CEOs say when their profit margins are secretly compressing underneath the surface. Let's do the math on this right now. Yes, gross margin ticked up slightly by 20 basis points to 55.9%, but that was solely aided by U.S. pricing actions. Operating margin actually dropped 70 basis points down to 29.2%. Why does that matter? Because if you are dropping 70 basis points on operating margin, those nominal dollar gains you love so much will instantly evaporate the absolute moment volume growth stutters. This explosive international sales growth is dangerously diluting their higher margin U.S. baseline profits. Average net sales per energy drink case actually decreased even as total case volume expanded. That is a massive, glowing red flag for their pricing power moving forward.
And when you start scanning these highlights from the 8K, the distribution costs jump out immediately. The longer your supply chain stretches across the globe, the higher the thermal stress on your operating expenses. Distribution costs rose sharply to $118.8 million, which is 4.7% of total sales, up from 3.9% a year ago. Management blames freight-in costs, fuel, and an unfavorable geographic mix. Do you know what that unfavorable geographic mix actually means? It essentially means that the more they sell in these booming overseas markets like LATAM and APEC, the less profitable each can becomes due to the sheer logistical cost of moving physical aluminum across the planet.
But you have to expect higher distribution costs when you are aggressively taking market share in developing logistics networks like India and Brazil. You're literally building the supply chain from the ground up in these regions. It's the heavy upfront cost of laying a permanent, ironclad global foundation.
Fine, but what about this massive SG&A burn? Q2 selling expenses surged to $269.2 million. That is 10.6% of sales, compared to just 9.3% last year. They are pouring an absolute fortune into Gen Z lifestyle marketing, social media, and elite sponsorships. They are paying hand over fist for a Lando Norris F1 SKU, a Morgan Wallen tour, massive UFC sponsorships, and a brand new Marriott food service deal. We need to heavily critique the true return on investment here. Do you know how many cans of Monster you have to physically sell just to break even on a Formula One sponsorship with McLaren? Operating expenses overall grew 24.7%, which heavily outpaced the 20.2% revenue growth. They are quite literally spending money faster than they are making it. You aren't just buying short-term impressions, you are buying long-term customer lifetime value. That marketing spend is exactly what is driving the massive household penetration and keeping the brand aggressively relevant to a broadening younger consumer base. You simply do not get 84% growth in India without putting serious, sustained cash behind the brand's global image. You can't market your way out of raw material inflation, no? We need to talk about the invisible risk of rising aluminum prices, specifically the Midwest premium. Tariffs are piercing right through their aluminum hedging strategy. Schlossberg himself warned on the call that they expect a continued, modest sequential increase in aluminum costs through at least the end of 2026. Despite selective pricing actions, these raw input costs are absolutely going to cause further margin erosion as the year progresses.
The company has transparently acknowledged they were temporarily underhedged on the Midwest premium recently, but they remain highly confident in their staggered ladder approach to manage it over the next 12 months. It's a known variable, and they are actively forging a solution.
Let's shift gears to Section 4, Capital and Catalysts, and look at how management is actually forging a path forward. We have several structural catalysts approaching fast. First, the board approved a 2-for-1 stock split to be effected in the form of a 100% stock dividend. The record date is July 24th, distribution happens after the close on August 10th, and the stock begins trading at the split-adjusted price on August 11th. But more importantly, to directly combat the aluminum inflation you just highlighted, management is initiating selective U.S. pricing actions in the fourth quarter, alongside additional hikes in EMA. Finally, we have an Investor Day coming up on December 1, 2026, which should provide deep, much-needed clarity on their long-term supply chain and pricing strategies.
Let's be real, a stock split does not change the fundamental valuation of the company. It's a purely cosmetic move for retail investors. And while price hikes sound great in theory for padding margins, passing those costs onto the consumer risks significant volume destruction. Think about it. If domestic volume growth is already softening down to 11.5%, what exactly happens to demand when a can costs 10% more at the convenience store? That elasticity is going to be severely tested.
And let's look at their capital allocation strategy for a minute. The 8K clearly states that 0 share repurchases were made in Q2. 0. If management truly believes the stock is a screaming buy at its current valuation, why on earth aren't they buying it?
Because they are being tactical with their capital deployment. They have $900 million in remaining capacity under previously authorized repurchase programs. That acts as a massive structural floor for the stock. Why hold it? Perhaps they are waiting for a broader macroeconomic dip to maximize shareholder value? Or perhaps they are keeping dry powder available for another strategic acquisition to fix or replace that struggling alcohol segment. That $900 million is a weapon, and they are choosing to keep it loaded for the absolute right moment.
All right, let's wrap this up with Section 5, the final verdict. Based on the raw data, my verdict is a strong buy and hold. Net income surged 19.6% to $584.5 million. Adjusted EPS hit 60 cents, a 15.2% year-over-year increase, beating consensus estimates of 58 cents. Gross margins expanded by 20 basis points to 55.9%. The international momentum we're seeing in LATAM and APAC is completely unmatched in the beverage sector right now. With zero sugar market dominance, massive pricing power ready to deploy in Q4, and $900 million in buyback capacity, this balance sheet demonstrates true physical durability. It is a financial fortress capable of withstanding the macroeconomic headwinds and supply chain stresses we've discussed today. Market skeptic? The top-line volume is ironclad, I will concede that point. But my final provocative thought for the audience is this. Are margin pressures, surging distribution costs, and raw material inflation going to eventually test the stock's lofty valuation? The operating margins are already showing real thermal stress by dropping 70 basis points, and the alcohol segment is a leaky valve that management needs to patch immediately before it rusts the rest of the operation. You have to decide if the incredible international growth can permanently outrun the harsh realities and rising costs of scaling a physical supply chain across the globe. That is the ultimate question for investors to weigh as we head into the second half of the year. Thank you for joining us for this deep dive into Monster Beverage Corporation. To ensure you never miss a granular, no-nonsense earnings breakdown, hit that subscribe button for Iron Financial right now. Keep your analysis sharp and your portfolio stronger. We will see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.